Once a company has a proper trial balance in place, it is time for them to create their financial statements. The reason we have to have the trial balance in place first is because most of the numbers when we prepare these financial statements that we're going to use are going to come directly from the trial balance. And I said most, not all. There are some numbers that have to come from other sources, but the vast majority are going to come from your trial balance. So make sure you have that prepared and set aside when you're making your financials. We're going to make the three main financials right here. They are the income statement, the statement of owner's equity, and the balance sheet. I listed them in that order because they have to be prepared in that order. The reason being is there are numbers on some financial statements that have to be transferred to others. There is a number that comes from the income statement that we're going to need on our statement of owner's equity. There's a number that we're going to calculate on the statement of owner's equity which has to go on our balance sheet. So we have to prepare them in this order. If we tried to do the balance sheet first, we wouldn't have all the information necessary because we hadn't done our statement of owner's equity yet. So again, always the same order: income statement, statement of owner's equity, balance sheet. And starting with the income statement, it's going to show our net income for the period. And to find that, you simply take your revenues minus your expenses. Well, we can take all of these numbers from our trial balance. And because we listed that trial balance in the proper order, they're all together. So we're going to take our revenues and expenses from the bottom of the trial balance. Parker Personal Training only had one revenue account. It was service revenue, and it was for $9,000. For expenses, they had four separate expenses. They had rent expense of $2,000, salaries expense of $3,600, utilities expense of $600, and advertising expense of $2,200. You may have noticed I put those in a separate left-hand column. On financial statements, if you have to total numbers up to find a total overall number, you put all the numbers that you are adding up in the left-hand column and just the total in the right. So for Parker Personal Training, when we add those four expenses together, we get $8,400. We put service revenue right in the right-hand column to start with because it was our only revenue account. But if we had 3-4 different revenue accounts, we would have put all of those numbers in the left-hand column and then put total revenues in the right-hand column. Regardless, we're ready to figure out what our net income was. It was our revenues, all of the work that we did during the period, minus expenses, all of the necessary costs that we incurred during the period. We had $9,000 in revenues, minus our $8,400 in expenses, means our income was $600 for the period. And we're done with the income statement. So now we get to move on to the statement of owner's equity. And this is probably the hardest one to make because you need to take the numbers from a bunch of different places. Four things you're going to need to have. Beginning capital, and that can come from your T account. At the beginning of the period, you're going to have some kind of capital that you carried over from the previous period, unless it's your first month of operations. So you're going to find that beginning capital balance from the T account. Owner contributions, money that the owner took from their own, say, personal checking account and put into the company bank account. That would be an owner's personal contribution, and those kind of things are going to be tracked in journal entries. So you're going to have to go back through your journal entries and figure out what your owner contributions were. Just a quick note, you could also find these from your capital T account if you made the journal entries correctly, because they're going to be additions to capital each time your owner makes a contribution of their own personal funds. Next, we're going to need net income, and this is why we had to make the income statement first, because the income statement found us our net income, and now we need to transfer that net income from the income statement to the statement of owner's equity. And then lastly, we need the owner's withdrawals, which we can take right from the trial balance. So on a statement of owner's equity, the first thing that we're going to start with is our capital at the beginning of the period. We have Sims Capital. I'm assuming that Parker Personal Training's owner's name is Parker Sims. And Mr. Sims here had capital at the beginning of the period, which we can find by looking at Sims Capital's T account. The beginning balance here was $47,000, so we're going to bring it on over. To that, we need to add any contributions. Well, this is a short example. We didn't have any journal entries that we're going through here. And as we can see from the T account, there's no additions to capital during the period. So let's assume that the owner's contribution was $0. Parker Sims put nothing into the company of his own personal funds this period. But the company was profitable because our net income, which we're going to take right from the income statement, was $600. So if we add those three things together, we get what I call the no-name subtotal, $47,600. That is our capital after additions but before subtractions. Well, what subtracts from capital? What subtracts from the value of a business? What subtracts from the value of a business is when the owner goes and withdraws money from the business for their own personal use. So we can find that number on our trial balance, and we see that Sims withdrawals during the period had a balance on our trial balance of $2,200. It's going to decrease the value of a business, or the amount of capital Mr. Sims has. $47,600 minus $2,200 is going to give us an end balance of Sims capital as of August 31st, 20XX of $45,400. And our statement of owner's equity is done. We're ready to move on to the last of the three main financial statements, which is the balance sheet. On the balance sheet, this essentially, it does show what you own, what you owe, what the value of the business is, but it also proves that your accounting equation is correct, that assets do in fact equal liabilities plus equities. That should always be true. The format that I use for a balance sheet is the classified balance sheet. So I break down assets into different classes. I'll break down liabilities into different classes. Keep it simple here. We should really know what is the difference between current and non-current, and that distinction is 1 year. So a current asset is something that you have that you're going to use in business operations, but you expect to use within 1 year. Entirely use it up, consume it. A non-current asset is something that you expect to provide profitability to your business, something you're going to use in business operations, but you plan on having it for more than 1 year. And for us, that class can be called property, plant, and equipment, right? If we have a piece of equipment, we're not going to use it up fast. Think of it like printer paper versus a printer. If we have a printer, that's an office supply. We plan on using that within a year. So supplies would be a current asset. The printer itself, I don't think we're going to plan on running the printer in the ground within a year. We plan on having it for more than a year. So we would put that under a property, plant, and equipment. For liabilities, current liabilities are the things that you owe within a year. Paying off your credit cards, paying your utilities bill, etc. Non-current liabilities, long-term debt, if you will, are things that you're going to have to pay for more than a year. So like a 30-year mortgage on a house, or a 3-year personal loan from a bank. Anything that takes more than a year to pay off wouldn't be a current liability, it would be a non-current liability. With that out of the way, let's make this classified balance sheet. Well, look at our assets. We have cash. We're going to use cash within the next year, so $13,000. Accounts receivable, we plan on collecting this debt that people owe us within the next year, so that's going to be $2,200. Supplies, we're going to use that printer paper within the next year, the cartridges, the envelopes, etc. So we're going to put that into current assets, and those are the three that we have. And when we add them together, we get total current assets of $19,200. For property, plant, and equipment, we have equipment. So let's throw the equipment in there. It has a value of $34,000. So when we add together our current assets plus that piece of equipment that's non-current, we get total assets of $53,200. Let's move on to our liabilities. What do we have for liabilities? Well, we have accounts payable. We got to pay our debt to people. Think of this like your credit card. We got to pay that off within the next year, so $5,000. We have utilities payable. We got to pay our utilities within the next year for sure. That's $600. And advertising payable, that's probably going to be due in the next year. That's $2,200. And when we total that all up, we come up with a total of $7,800 in current liabilities. Parker Personal Training doesn't have any long-term debt. We don't have a mortgage. We don't have a long-term, loan from a bank that we signed a promissory note for. We don't have any of that stuff, so they don't need to list anything. But if they did, it would be a different class. All they have left to list is their capital, their owner's equity account. And the first instinct is just to take it from the trial balance, because you've been taking all of the numbers from the trial balance. But for capital and capital alone, you don't. We had to prepare numbers in a certain order, so we had to prepare our financial statements in a certain order, because we need this number of Sims capital to be current as of the end of the period. So the number that we're going to transfer over isn't the amount that was listed on the trial balance, but instead is the bottom line of the statement of owner's equity. Mr. Sims' capital as of August 31st, 20XX was $45,400. And when we add that to the $7,800 in liabilities that we get, we also get $53,200, which we should, because assets should always equal liabilities plus equity. The total on the left-hand side of this classified balance sheet should always be equal to the total on the right-hand side two numbers always have to be equal.